Hey everyone, and welcome to The Explainer. We look at billionaires, and we usually just assume they've got some wildly complex, totally impossible to understand secret, right? Well, today, we're going to demystify the legendary investing success of the Oracle of Omaha himself, Warren Buffett. We're literally opening up his proven toolkit, and as you'll see, intelligent investing is actually delightfully simple. Now, as Buffett would say, it's not always easy, but the concepts, they're straightforward. So let's dive right in and break down his core strategies so it's all crystal clear.
So let me ask you this. What if you only had 20 investment choices for your entire life? Just sit with that for a second. We live in this crazy era of rapid-fire day trading, screens flashing red and green, nonstop stock tips on social media. But Warren Buffett and his late business partner Charlie Munger, they've always believed that true wealth doesn't come from chasing a brand new stock idea every single day. Instead, they suggest this really radical thought experiment. Imagine I handed you a ticket with exactly 20 slots punched in it, and those 20 slots represent all the investments you get to make in your entire lifetime. Once you punch through that card, that's it. You're done. No more investments, ever. Think about it. How much more carefully would you weigh your choices?
So here is exactly what we're going to unpack today. We'll look at that 20-slot punch card, your circle of competence, Buffett's 4 golden rules, calculating value and safety, and finally, the index fund advantage. Okay, let's start with Section 1, the 20-slot punch card, bet selectively.
Moving right along to Section 2, your circle of competence. Know your boundaries.
Now, to actually use those precious 20 punches wisely, you really don't need to understand every single business on Wall Street. You just don't. You only need to identify what's called your circle of competence. It's basically a mental framework that highlights what you actually know from your own experience. Because look, if you start making decisions with incomplete knowledge, your chances of making a really costly error just absolutely skyrocket. Buffett's whole philosophy is that an intelligent investor should strictly focus on the few companies that sit safely inside their circle. And honestly, here's the real secret. The actual size of your circle, it doesn't matter that much. What is absolutely crucial is knowing exactly where the boundary of that circle is and just refusing to step outside of it.
Next up, Section 3, Buffett's 4 golden rules, the valuation mechanics.
All right, so once you find a company that sits safely inside your circle, how do you decide if it's actually worth using one of your punches? Well, it has to meet 4 strict rules, period, no exceptions. First, it absolutely must be managed by vigilant, great leaders. Bad management will eventually ruin even a fantastic business. Second, it's got to have long-term prospects. Remember, buying a stock is exactly like buying a proportional share of a real, physical business on Main Street. Think about it. You wouldn't buy a local bakery today just to flip it and sell it to someone else tomorrow, right? You'd hold it forever to collect the profits and avoid massive capital gains taxes. Third rule, the business must be stable and understandable. Predictable cash flows make a business so much easier to value. And fourth, it absolutely must be undervalued.
Which brings us to Section 4, calculating value and safety, the math behind the magic.
Going back to that bakery example, you'd never just buy a local bakery without calculating what it's actually worth first, right? Well, buying a stock without a clear valuation is just as reckless. Buffett figures out this worth by calculating something called intrinsic value. And the best part? He completely ignores all those super complex Wall Street formulas, the CAPM models, the beta. He throws all that out. Instead, he just looks at what he calls owner earnings and discounts them using a simple, long-term government bond rate. This is exactly why he loves stable businesses, because their future cash flows are actually predictable, which makes this intrinsic value calculation way more reliable. And don't worry, the formula for owner earnings is definitely not calculus. It's really just basic arithmetic that you can pull right off a company's cash flow statement. You just start with net income, then you add back non-cash charges like depreciation, depletion, and amortization. You add the change in deferred tax, then, and this is the really crucial part, you subtract the 5-year average of maintenance capital expenditure. Basically, that's just the money the business actually has to spend to keep the lights on and stay competitive. Finally, you just add the change in working capital. See? It's a totally straightforward recipe, and it reveals the true cash a business is actually generating for its owners.
Okay, so you've calculated the intrinsic value. The real question is, what do you do with that number once you have it? Well, you apply a margin of safety. This is essentially the gap between what the business is actually worth and what the stock market is currently charging you for it. Most successful value investors typically demand a margin of safety of at least 25%. And honestly, this just gives you massive psychological comfort. It acts like a protective shield against unpredictable market swings or, just simple human error.
Because here is the absolute truth, beautifully summed up by Buffett himself. It is better to be approximately right than precisely wrong.
Look, valuation is highly subjective. Literally every investor is going to calculate it slightly differently. That 25% margin of safety protects you because, let's face it, you are never going to get an exact perfect number. You just need to be approximately right, but with a nice big cushion built in for safety.
Let's head into our final section, Section 5, the Index Fund Advantage, the Ultimate Hack.
Okay, prepare yourselves for the ultimate plot twist here. We literally just went through all the exact mechanics of valuing individual stocks, right? But Buffett's primary advice for 99% of people out there is actually way, way simpler. Think about it like this. On one side, you have active investors, people paying incredibly high fees to managers, constantly trading and trying to perfectly time the market. On the other side, you have passive investors. These are people paying virtually zero fees and just sitting tight in a broad index fund for decades. Buffett points out a cold, hard mathematical certainty here. Because active investors rack up massive fees and trading costs, as a group, their net results will literally always be worse than passive investors. Passive just beats active simply by avoiding those corrosive costs.
Now, Wall Street really wants you to believe they have some kind of magic touch. But Buffett uses this absolutely hilarious analogy to burst that bubble. He says that if you had 1,000 monkeys making market predictions, a few of them would be right 9 years in a row purely by chance. Wall Street is basically full of lucky monkeys charging exorbitant fees. It is so incredibly difficult to separate true market-beating talent from pure luck. And that is exactly why paying someone else to pick your stocks is usually a losing game for the everyday investor.
And the amazing thing is, Buffett absolutely puts his money where his mouth is. When he was planning for his own family's financial future for after he's gone, he didn't tell his trustee to go out and hire some fancy hedge fund manager. No way. Instead, he left astonishingly simple, strict instructions for his wife's trust.
He laid out an incredibly precise, easy-to-follow asset allocation. Exactly 90% of the cash goes into a very low-cost S&P 500 index fund, and he actually specifically suggests Vanguard for that. Then the remaining 10% goes into short-term government bonds, and that is literally it. This split is brilliant because it perfectly captures the incredible long-term growth of American business while still keeping a 10% cash cushion for total security whenever there's temporary turbulence in the market. So how can we actually replicate this billionaire's strategy right now? Well, it's pretty simple. Pick up broad index like the S&P 500 or the MSCI World Index. Make sure you're using low-cost ETFs so those pesky fees don't eat up your wealth. Accumulate those shares steadily over a long period of time. And here's the most absolutely crucial rule of all. Never, ever panic and sell when the news is bad and the market drops. You just keep buying through thick and thin.
Which leaves us with one final, really important question to think about. Are you going to spend your life exhausted, constantly chasing the next big trend and handing over exorbitant fees to Wall Street? Or will you embrace the powerful, disciplined simplicity of the Oracle's toolkit? Because whether you use your 20-slot punch card to meticulously value a few wonderful businesses, or you just take his ultimate advice and steadily buy an index fund for decades, the power to take control of your financial future is completely in your hands. Thank you so much for joining me for this explainer, and I'll catch you next time.